If you're an experienced investor chasing your first big commercial in property, but feel stuck in small deals that don't move the needle, this video could be your turning point. Because I'm not just going to explain the strategy I use with clients to help them scale fast, I'm going to show you. So that's right, in this video, I'm going to walk through a live demo of how I help my clients build their buy box, their scale box is what I call it, using real market data and intelligence step by step. And this can work regardless of where you're investing across the country. But first, let me give you some context because the ScaleBox is the very first thing we do inside the Go Bigger Sooner program for a reason. Before you go hunting for deals, you've got to know where you're hunting and what you're hunting for. We start by building your buy box, which means clearly defining 1, the asset type, 2, the unit range, 3, the location filters, and 4, the price per door sweet spot and cap rate sweet spot that we know is going to work using our model. And why is this important? Because setting up deal flow infrastructure takes a lot of work. Calling brokers, pulling lists, building local lender relationships, even a direct to seller outreach. You don't want to do all that work in a market where you're chasing ghosts. And here's the thing, and the brutal truth is that you may be used to buying 1 to 2 deals a month if you're buying small multifamily types of properties. But when you're going after your first larger deal, you're going to put a lot more work, a lot more deposits into the universe in terms of walking properties, calling brokers, making offers on properties, analyzing properties, and the whole 9 yards. And what this does, I do not want this to be wasted energy for my clients. I want this to be deposits that are going to pay them dividends later. And what this turns into is their second, third, fourth, and fifth deal happening in rapid succession to that one. So in building the scale box, I want to make sure that we have enough product within a market area that we can actually build a foothold and infrastructure so that we can actually take market share consistently year after year. So number 1, we want to avoid the cap rate trap. There are 2 deadly traps for commercial investors. 1 is market with cap rates that are too high. Sure, they may be cash cows, but you can't create meaningful value. Every dollar of net operating income is that much less accretive to increasing the value of the property. And 2, markets with cap rates that are too low, where you have to raise 40 to 50% of the equity up front just to make the deal pencil from a debt service coverage ratio to get financing of the property from a community bank. And in either one of those cases, you lose control. You either can't force appreciation or you have to give away the deal to investors. What we want is a market where you can raise 20 to 25% of the equity, use a value-add strategy, and exit or refinance the property in less than 5 years. So first and foremost, I get approached by a lot of clients with they have the idea that, okay, I need to go outside my market to get access to bigger deals. And I want to challenge that assumption because the one thing is that you've spent all this time, you've already created a sizable portfolio within your own market, whether it's in your own backyard or someplace else. And you've created a lot of infrastructure, relationships, market intelligence that I don't want to throw away. I want to create a strategy, a custom blueprint for you within which to build an acquisition strategy that you can actually scale. So what I want to do is I want to bolt on what you've already built and apply it to acquiring bigger deals. The second part of this is the inventory rule, and this is what I call the rule of the 500. So your chosen market and asset type, your specific buying criteria that I help you develop must have at least 500 existing properties that match your buy box that we create together. The reason why is because only 2 to 4% of properties in any given market segment will trade each year. If you're in a market with 50 qualifying deals, 50 properties that exist altogether, that's maybe 1 to 2 sales a year. And there's always going to be some guy that flies in from out of California with more money than brains and on a 1031 exchange that's going to pay more for those deals than you ever will be able to. So we want to make sure there's a certain amount of abundance in that market. So you're able to look at between 8 to 12 properties that trade each year with the intention that you will land one of them. Now here's where it gets analytical because building your scale box isn't just about quantity, it's also about quality of demand. There are 3 demographic metrics that I always want to look at. Number 1 is median household income. We want to invest in submarkets where median household income is at or above the metro-wide average. That's a proxy for stability and upward mobility. The second piece is rent affordability versus rent growth. If a submarket has a median income of $50,000, applying the standard 30% housing affordability rule, meaning that, and this is a rule by HUD, is that anybody that pays over 30% of their income on housing is actually housing burdened, which means Rent increases, yeah, you might be able to get them, but you're going to rent burden your tenant and you're going to have a disastrous situation from an affordability perspective. So in an area that has a $50,000 median income, that has about a $1,250 a month in rent to general affordability threshold. If actual rents are only $1,000 a month and the vacancy rate is below 3%, for instance, this suggests that rents still have room to grow. You have a captive audience, a captive population that can afford to pay more rent. And then thirdly is the price to rent ratio. This is really an often overlooked indicator that I use to measure cost to own versus cost to rent. So if the median home price in a market is $195,000, for instance, I'm going to go into a specific market in this live demo to find out this information, and the monthly cost to own, including taxes and insurance, is around $1,200, then if market rents are also $1,200, this is a moment for us to actually pause, because I've owned and managed apartment complexes. Actually, there was an area that I owned a 72-unit apartment community in, and this was a newer build that we thought that rents were like drastically below market because we were comparing it to an area that was adjacent to this, that was higher income. This was a rural area. And every time we tried to push rents above $880 a month, we'd have market resistance. The apartments would have a longer days on market, and we'd have sustained higher vacancy and collection loss as a result of that. And the reason is because all of the houses that were within that area, the average or median home price in that area was $75,000, okay? So really anybody with a good head on their shoulders, decent credit, paid their bills on time, decent income could own way cheaper than it was to rent. So this actually gave us less power in being able to increase rents and improve a property over time. And then we were specific about what you're looking for. 20 to 40 unit apartments built after 1980, under $90,000 a door. It activates what's called your reticular activation system. Have you ever bought a car before, let's say a black Honda Civic, and then all of a sudden you start seeing black Honda Civics all over the place? This is how people remember you, by being very specific about what you're looking for. I work with clients across the asset spectrums, and this is what I'm going to do too in this training, in this live demo, is okay, if we can't find multifamily in this area that meets this rule of the 500, how much retail product exists? How much industrial product exists, right? So when you can say, hey, I'm looking for retail strip centers that are between 10,000 and 50,000 square feet, that are 70% plus occupied, that are near hard corners, that have national retailers around them, that high degree of specificity does not pigeonhole you, right, with other investors, building owners, and also brokers. It actually empowers you to be first top of mind. Deal actually comes up that's off market. I've covered this before in previous trainings. If you say, hey, I'm looking for anything that makes sense, right? Multifamily or retail, industrial, wherever, I'm looking, whatever makes sense, anywhere in the country at whatever point in time, right? But if you're looking at buying this specific thing in the next 12 months to actually communicate a level of urgency in terms of what you're looking to accomplish within this year, then what ends up happening is you will start to get actually more deal flow. You're not pigeonholing yourself into this small little box. For instance, I have a client, Rob, for instance, he bought I think it's like a 35,000 square foot medical office building. His criteria he was communicating out was, I'm looking for 10 to 20,000 square foot medical office buildings on the east side of town, okay? And what he ended up getting off market was a 35,000 square foot pseudo medical office building. It wasn't like doctors and dentists and that sort of thing in there, but it was actually like pseudo medical wellness types of things, massage therapy, acupuncture, all that sort of thing. And this person that referred this deal to them knew that criteria and was like, hey, Rob, this may not be your cup of tea, but I thought of you. The idea is by being specific, you get first on the list. And so now you're not chasing deals, you're attracting them. So now that you understand the logic behind the ScaleBox strategy, I'm going to walk you through a live demo where I actually show you how to survey metropolitan area, how I cross-reference median income, rent levels, and home prices, and how I determine if a market abides by the rule of the 500 or if it's a dead end. And this is exactly what I do with clients in our onboarding process, and you're about to see it in real time. Okay, so this is the software program that I have a subscription to. It's called CoStar. I wouldn't advise buying it unless you're in a business like mine or you're a commercial real estate broker. It's about $10,000 a year. I pay for this to have access to markets across the country. And I utilize this very heavily when I'm using the actual ScaleBox, okay? So I have a client that I'm about to onboard pretty soon, and I'm doing the preliminary research in the market before our onboarding call to look into this market. They own property on the west side in Baton Rouge. I'm going to look in this, like I said, I'll look into markets where they're actually currently invested or where they have some sort of footprint within which to build this like first deal infrastructure over. All right. So that being said, okay, so I carved out this using a polygon. Now I do this in much more painstaking detail, and already right off the bat, I'm seeing that there's only 1,000 properties that exist in here, regardless of asset type. So if I go in here and I plug in multifamily between 10 to 50 units, which is a general area where my clients acquire property, there's 77 properties that exist in this area. Okay. That is not nearly enough to actually build a sustainable footprint within which to scale in a market. Remember, we want to have 500. So this is where I'll actually, and we have two choices, right? We either go outside this area, or what we do is we change asset classes. And a lot of times what I'll do is I'll actually go on this and you do not have to have experience in other asset classes for to be successful in this. I had the experience in it. I used to be director of operations for a national real estate development company where my job was to take over assets from private banks and private creditors and make them as bankable as quickly as possible. So I understand how capital markets work, where the self-storage, office, medical office buildings, student housing, hotels, retail, industrial, you name it. I've touched it and turned those properties around. So I will help you with this. My clients, they know Josh, Chad, Carlo, just to name a few, never had any experience in like that. So do not be afraid of other asset classes. I teach clients on how to actually de-risk these deals and make them actually like they love when they get away from residential. And I did like about 5 or 6 years ago. I've just been focused on commercial asset classes. Okay. So that being said, I went on a little bit of a tangent, but now we're going to transfer this over to retail. More product. Actually, let's take a look at the actual property size, right? Because we want to target between 10 to 50,000 square feet. We have 37 properties. So not great, right? So we're going to have to go outside the geographic area. And this is the greater Baton Rouge area. And the other thing we want to do too, in terms of evaluating the market, is we put on these heat maps here, okay? And we see a lot of clustering of deals that are over this way, right? So we have 870 properties. The only problem is that when we go down to actual median household income, and this is what I found off of this, is it's very spotty as to where these are. And generally speaking, we want to avoid the red areas where we have median incomes that are like way below the average. This it indicates that it's high poverty areas where you're going to have issues with attracting good tenants, whether it's residential or commercial types of uses. We may pull in actually areas that are like this. Now you get down further here. This is a little bit more of a tougher area. I take this granular approach and really building out a market that's going to work for my clients. All right. And then we're to take a look at, okay, we have, like we had said, median home value. This is really important when we're looking at actual apartment deals. And so we want to have an area and a sub-market where the median home value, and you can run the analytics out here of like when you actually factor in school taxes, property taxes, and also interest rates as to what the monthly cost would be for owning a house. All right. So this is a really powerful tool with that. We do not want to buy in areas that's like where the cost to own is way cheaper than it is to rent, for instance. Okay. So this is where we'll build that granularity of things here. Okay. And this is all data that's scraped off of it. CoStar is actually the biggest researcher in the country besides the Bureau of Labor Statistics. Okay. So they have a lot of data in here that are used as a tool to help my clients in establishing this and curating this buy box. So the other thing that we do too is that when we start to maybe switch outside of an asset class from residential multifamily, for instance, it really opens up a lot of doors because residential multifamily, 10 to 50 units, it's a more difficult property to manage from a management intensity standpoint. But retail, for instance, or industrial, you can have a far greater geographic area that you can pull in because those deals are a lot less management intensive. Just think about it, right? You got 8 tenants at a retail strip plaza, assuming it's in a good location. You have good occupancy. You have good area incomes to support the retail tenants. And then these tenants are either on 3, 5, 7, 15-year leases. And all of the common area maintenance that you are responsible for is the roof, the lawn maintenance, and also the snow removal if you're in markets up north and in the Midwest. All of this stuff, and even HVAC preventative maintenance contracts can all be managed remotely. All right. And then when a tenant's lease rolls off and vacates, for instance, then you hire a broker, for instance, that's going to put a lockbox on that space and they're going to be responsible for leasing that space up to another retail tenant. So you can actually start to grow your geographic area as a result of this. So this is all the types of stuff that I do when I onboard a client and building out their buy box. Now, I only spent probably maybe 7 minutes doing this with you right here, but this is one of the things that we do in establishing what is that criteria to be for a winning acquisition strategy. So after we find this location and the asset class, and we pull into the demographics, right? So this is a completely different market than the one that I was talking about before, but it'll give you a sense about what we do in our process so that whether you hire us or not as your advisor in scaling to bigger commercial deals, that you'll know what our process is. So if you just choose to do it on your own, you can do that. And when we look at the favorable demographics, the property amount that you see right here, what I use this tool for is the good thing about actually having a data set size that's 500 properties or more also is that you get a much better, more accurate representation of it, right? Because so if you only have 3 properties in a market, CoStar is not going to really be a good resource on really getting a sense of what the market fundamentals are in terms of rent price per square foot, market capitalization rate, and even vacancy right here. So this is a quick high level. Once we actually find the area, you want to confirm that it has a cap rate that's going to be favorable to our typical model, which is a cap rate that are above 6.5%, okay? When you get into high growth markets, or let's say high barrier to entry markets like New York City and Los Angeles, or even secondary markets like Boston that have sub 5% cap rates, yes, it's great for value add types of deals where you can, every dollar of net operating income is that much more explosive to the underlying asset value. The problem is that you have to raise an enormous amount of capital up front, sometimes 40 to 50% the actual transaction size, because it does not meet debt service coverage ratio that most banks want to do. So in this type of market here, we have especially a 7.5 to 8% plus capitalization rate like this market. This is great because we can take these deals down with 20 to 25% down rather than 40 to 50%. And then also is not high enough so that when we are looking to turn these properties around, that there is market fundamentals that are working against us with extremely high capitalization rates, which you can see like where in this example here with these demographic overlays, if you're going into the city of Rochester and all these red areas that have a median household income below $31,000, this is not going to be healthy for retailers, right? This is in general is a good market. We have a good vacancy rate that's in this market as well at about 5%. So we can plug that in and budget for vacancy and collection loss with these retail deals. I hope you got value out of this, and just remember those metrics, right? The rule of the 500, median household income, median home sale price if you're looking at residential multifamily, and also remembering to not be afraid to be super specific in terms of what your criteria is. The more specific you are, the better position you're going to be at building out that deal flow infrastructure. And if you're looking for more help on this, right, not only in building your buy box, but how to structure your balance sheet, how to actually underwrite commercial deals, how to raise capital without having to do a syndication. All right, my clients, my name of my program is Go Bigger Sooner, but bigger being we're doing deals that are sub $10 million, my clients are. Those do not require syndications. We can put together those deals with small ownership groups. And then how to make heads or tails of opportunities, put together business pitch decks to investors and banks. I also help you develop the value add strategy for that specific property so you know that if you do X, Y, and Z to that property, exactly what's going to be worth conservatively within 5 years or less, how to buy a deal, rapidly increase it in value, refinance it, take your investors out, and repeat this thing over and over again until you reach your big, hairy financial goals. If this sounds interesting to you, this is my offer, is that I will help you land your first bigger commercial deal that's going to add $500,000 to your net worth minimum, $500,000, $50,000 a year in cash flow minimum in 1 year or less, or you don't pay. All right. So if you're interested in learning about how I can help you specifically accomplish this goal, make sure to check the link below and book in a call today.